I am back with a brand new trading video, and in this one, I'm going to cover a simple way to help you identify the best place to enter a trade and when you should exit it. We are talking about Fibonacci retracements. This is a popular tool among technical traders, and there are quite a few different ways people use them, so let's do a quick overview. In mathematics, Fibonacci numbers form a sequence where each number is the sum of the two preceding ones, starting with 0 and 1. Fibonacci sequences also appear in nature, like the arrangement of leaves on a stem, pine cones, etc. Now for trading, it's often used to measure the vertical distance between a peak and a trough, and then the Fibonacci tool divides the vertical distance by key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%. These then can help you identify possible areas of support and resistance. Luckily, just about every charting platform has the Fibonacci retracements tool for you to use. Here in TradingView, which is free to use, the tool is right here. So like anything else, this isn't some magical tool or indicator that will automatically make you a profitable trader.
Over time, with enough volume, we become profitable.
You'll want to use Fibonacci retracements in addition to other forms of analysis. So before you enter a trade based on Fibonacci levels, visually look to the left on the chart and find previous areas of support and resistance. You might also want to look at the S&P and see if it's also looking strong, and so on and so forth. The most common way I use Fibonacci is to measure the opening range. Let me pull up DocuSign's chart from this morning. After the first 30 minutes of the market open, I'll find the highest point, click with the Fibonacci drawing tool, and click on the lowest point. This automatically plots out specific levels, but I'm only interested in a few, so let me show you which ones I have enabled. I have the 0 line, 1, negative 0.618, negative 0.272, 0.618, 0.5, 1.272, and 1.618. Now, oftentimes I'll find a stock that had a nice run up at market open and then enter on a pullback. So you could add a moving average to do this, like the 9 EMA. That's fine. You could also use a Fibonacci trigger zone. So this is the orange zone here between 0.5 and 0.618. Ideally, we want to see the price come down to 0.5 and then work its way back up. So we have our range mapped out with the Fibonacci retracement tool. Let's look for an entry. Okay, so we hit our 0.5 and even broke below it. So let's wait to enter. Okay, we can see the stock isn't doing a whole lot, kind of chopping around in this zone. I'll draw a trend line over the top and look for it to break. Okay, so we broke out of the downtrend, so we could enter on this next candle. So our first take profit would be the 1.272 level, and our stop loss I want to put just below these recent lows. If the stock isn't moving how I'm expecting it to, we can cut the trade there for a small loss. This gives us a 2.19 to 1 risk reward ratio. Let's see how this would play out. Whew, it came pretty close to our stop loss, but it started picking up strength, and about an hour later, we are at our first take profit level. Now here we can decide to exit completely or start to scale out of the trade. If the market and this particular stock is still looking strong, we can hold some of our position with the 1.618 target as our final take profit, which is a 3.4 to 1 risk reward ratio. We could also move our stop loss to the 1.272 level if we wanted. We can see we did hit the 1.618 level, which, definitely doesn't happen every time, but that would have been a pretty nice trade. So that was a good example of that strategy. We take the 30-minute opening range, use fibs to divide the distance and provide us with targets. Then we wait for the stock to come into our trigger zone. I often find a lot of times stocks will chop around in this zone for a while, so I'm usually patient on my entry. I want to see it breaking above any downtrend, and if there's still strength in the overall market in this particular ticker, I will enter and keep my stop loss just below recent levels of demand. My first take profit is the 1.272, and my final take profit is the 1.618 level. Now, while I didn't catch that DocuSign trade, I did take a Facebook trade. Now, I didn't really have a good entry because I didn't wait for a better pullback or for the 30-minute opening range to develop. So this trade turned red on me pretty quick. My stop loss was just under this pre-market area of support, and with options, I'm using mental stop losses. So we can see it pretty much came down and tapped that level, but then we had a nice green candle pushing it back up, so I stayed in the trade. Now, so in this example, I actually decided to hold it past the 1.272 target because it blew right through it, retested it, and then had another big candle up. So I ended up exiting the trade completely in between these two fib levels. Now, this wasn't a huge win or anything, but still a decent trade, and the fib levels helped to give me these take profit levels. Facebook actually had a great day and continued running far past my fib levels and even retesting the 1.618. We can also use the same concept for a downtrending stock. Maybe we see that Nvidia had a weak close the day prior, and we'd like to buy put options on it. Again, let's map out our 30-minute opening range. Several times the price wicks into our trigger zone, so we could enter a trade here. Our stop loss would be just above these wicks outside of the zone, and negative 0.272 is our first take profit level, which gives us a 3-to-1 risk reward ratio. We hit our target less than an hour later, and again, we can exit completely, or if we think there is still more downside left, we can hold a partial position with negative 0.618 as our final take profit level, which would be a 7-to-1 risk reward ratio. That worked out really nicely, almost too nicely. So let's look at a few examples where it doesn't always work out so perfectly. Here's an example of a strong opening from Apple. Mapped out with fib levels, now we just want it to enter when it hits our trigger zone. Well, it had no time for us and just continued on with us just sitting in its glorious designed in California dust. This is where if you were entering on something like a 9 EMA pullback, you could have gotten in on the trade, but trading using the fib trigger zone would have left you behind. So here's Square. The first 30 minutes don't look so great. It gapped down to open and just looks weak. We map out the first 30 minutes with the fib levels and maybe buy puts when it hits our trigger zone. Well, boom, we got stopped out almost immediately. Square decided to reverse and run the other way, where if we were in call options, well, these fib levels would have been great, but that's why I usually like to wait and see how price interacts with the trigger zone before entering a trade. Another time when I'd probably hold off on this strategy is when there isn't clear strength or clear weakness, when a stock is just kind of chopping around. Here is Airbnb with our opening range. Looks kind of weak, but if you thought strength was building and decided to go long when it came to the trigger zone, well, you might have thought you made the right call, but this massive candle would have knocked you out fast. And look at it hitting our bottom fib level just about perfectly. So let's recap exactly how to implement the strategy in your trading. First, identify the stock you want to trade. Second, 30 minutes after market open, use the Fibonacci Retracement tool to map out your levels. Next, for a bull position, you want to see a strong opening. For a bear position, a weak opening. And then if price action is choppy, leave it alone until there's a clear direction. Stop loss should be just outside the trigger zone. Start scaling out of the trade at 1272. Second take profit level is 1618. So again, there isn't one bulletproof tool. It's just another thing that you can add to your technical analysis arsenal. This has helped me a lot with my trading though. Many times I wouldn't have such a concrete take profit level and just kind of exit the trade whenever I was happy enough with the percent return. But there are so many times where I paper handed a trade. I sold it too soon, and then I watched it come up, hit my fib targets. So I definitely recommend you trying it out for yourself. There are so many times where the fib levels work so uncannily well, so you might as well see how it can help you. I hope you found this video to be helpful. And if you did, go ahead and tweak that thumbs up button, subscribe if you haven't already, and I will see you in the next one.